Gold just printed $6,000 in Chinese weekend trading, while the major Western exchanges were closed, and a Chinese bank warned customers it may suspend gold business because volatility is extreme and liquidity is drying up. At the exact same time, Iran's Supreme Leader was reportedly killed in a direct strike. Missiles were flying across the Gulf, and the market's safe haven bid detonated in real time. That is what happened, and if you think this is just another weekend headline that fades by Monday, you are looking at the wrong story. Because the real story is not simply that gold jumped. The real story is that the physical market moved first, while the paper market was asleep. The real story is that stress is no longer theoretical. It is showing up in bank notices, in halted trading windows, in regional airspace disruptions, in oil risk, in war premiums, in the kind of panic buying that changes price discovery itself. And if that sounds dramatic, good. It should. Because dramatic is what the last 24 hours have been. Stay with me because I am going to walk you through what triggered this move, why a bank warning matters more than a chart pattern right now, why silver may be even more explosive than gold in this setup, and why the next market open could be one of the most violent repricings we have seen in years. Subscribe right now, and when we get to the end, tell me in the comments what opens first on your watch list: panic, disbelief, or the biggest metals move of this cycle. Now let us slow this down just enough to see the chain reaction clearly. The first layer is war, not rumor, not diplomatic theater, not the usual exchange of threats that traders shrug off after a few hours. We are talking about a sequence of events that ripped away the market's assumption that this would remain contained. Coordinated strikes, senior officials killed, regional retaliation, missile impacts near critical allies and bases, Gulf cities under pressure, air routes disrupted, energy nerves lit on fire. Then came the second layer, and this is where the psychology changed. Iran's top leader was reportedly killed. That is not a normal escalation. That is not a symbolic strike. That is the kind of event that takes a conflict out of the realm of managed tension and throws it into the realm of historic rupture. Because once a state believes its leadership itself is under direct attack, the off-ramp gets harder to find. The room for face-saving gets smaller. The people left standing are usually not the doves. They are the men who believe escalation is the answer. That is why gold did not merely tick higher. It lunged. And it lunged in the only places still trading while the traditional exchanges were dark. That matters. A lot. Because when price is moving in weekend channels while the big paper venues are closed, you are getting a glimpse of what participants are willing to pay when there is no comfortable illusion of normality around them. No opening bell, no analyst panel, no carefully worded central bank statement. Just fear, urgency, and bids chasing scarce safety. That is how you get a number like $6,000. Some people hear that and think target. They think prediction. They think maybe. No. In this script, $6,000 is not a forecast. It is a statement about where demand already went when missiles, uncertainty, and physical stress hit at the same time. Real buyers, real money, real urgency. And then came the bank notice. Read that part carefully, because it is the detail that tells you this is not only a geopolitical story. A Chinese bank warned customers that because of intense price swings and thinning liquidity, its gold-related business could be temporarily suspended. Buying, selling, physical exchange, potentially frozen. That is not a sensational thumbnail. That is the kind of message institutions send when the flow of metal becomes more fragile than the public realizes. Think about what that means. A bank does not casually tell customers it might have to step back from gold if everything is functioning smoothly. It does not float that kind of message because someone drew a scary candle on a chart. It does it when access itself is becoming a problem, when the system is under strain, when inventory, settlement, or liquidity is no longer something management wants to take for granted. That is not a pullback story. That is a fracture story. And once you understand that, the move in gold stops looking outrageous. It starts looking logical. Because gold is not reacting to one headline, it is absorbing an entire stack of risks at once. War escalation risk, oil shock risk, shipping risk, banking stress risk, physical supply risk, policy paralysis risk, and above all, trust risk. Trust in stability, trust in containment, trust that markets open Monday and everything goes back to behaving like spreadsheets said it should. What if it does not? What if the price that closed on Friday was a price from a world that no longer exists? That is the question traders should be asking right now. Because Friday's close belonged to a reality where the weekend had not yet delivered a leadership strike, a fresh wave of regional fear, and a bank notice hinting that gold access itself might tighten. If the underlying reality changes that fast, the old close is not a fair value. It is stale information. And stale information gets punished hard when markets reopen. Now let me tell you why this could get even bigger. Most people hear gold at $6,000 and stop thinking. The number is so huge it consumes all attention. But the more important issue is what happens when the paper market has to catch up to what the live fear market already priced in. That is where things can become disorderly. Because if you reopen a heavily watched market with a giant gap between prior close and current panic value, you do not just get buying, you get forced buying. You get short covering. You get market makers widening out. You get people who thought they had time realizing they do not. That is how cascades start. First, the discretionary buyers rush in because they do not want to miss the open. Then the trapped shorts start covering because the new price is already above their pain threshold. Then risk models trip. Then margin pressure builds. Then momentum funds see the breakout and add fuel. Then financial media starts explaining after the fact why the thing that looked impossible 12 hours ago is suddenly obvious. By then, the move is already underway. And while all of that is happening in gold, silver is sitting there like a coiled spring in a much smaller room. This is the part too many people underestimate. Gold is the giant. Silver is the pressure vessel. Gold can absorb massive institutional flows because it is larger, deeper, and more widely held by central banks and funds. Silver does not have that luxury. Silver is a much thinner market. That means when fear money spills over from gold into silver, the percentage move can become savage. And unlike gold, silver does not only face safe haven demand, it also faces industrial demand that does not politely step aside during a conflict. It can intensify. Think about what an active military environment actually consumes: guidance systems, electronics, sensors, communications equipment, satellite-linked systems, power infrastructure, precision hardware. Silver sits inside more of that chain than most people realize. Then add solar, add electronics, add existing industrial demand that was already there before any missile flew. Add investor demand chasing protection. Add a supply side that was already tight in key areas. Now you have a market with three problems at once: investment demand rising, industrial demand still pulling, supply not flexible enough to answer quickly. That is why silver can become more violent than gold in the exact same crisis. Gold primarily says, people want safety. Silver says, people want safety, industry still needs metal, and the market is too small to handle a stampede gracefully. Those are not the same setup. And there is another reason this matters: perception lag. People understand gold in a crisis. They may not own it, but they understand it. Silver is different. Silver often gets ignored until the move is already underway. It is treated like the little cousin, the secondary trade. The metal people remember after gold has already made the headline. But once silver catches the narrative, it does not move politely. It jumps, it squeezes, it shocks people who thought they still had time. That is why the bank warning on gold should make you think immediately about silver. Because if the larger, more established monetary metal is showing stress signals in access and liquidity, what do you think happens in the smaller market if real panic broadens? There is less room, less inventory cushion, less tolerance for simultaneous safe haven and industrial demand, less ability to pretend everything is fine. Now connect this back to oil. The Strait of Hormuz is not just a map detail, it is a global pricing nerve. If conflict risk around that corridor rises sharply, insurance costs jump, shipping risk jumps, energy volatility jumps, and when energy jumps, inflation expectations do not calmly wait for a policy committee to catch up. They reprice instantly through transport, fuel, logistics, agriculture, and manufacturing. That puts central banks in a trap. Because if inflation heats back up through energy, while growth confidence weakens under war stress, what exactly is the elegant answer? Tighten into fear? Ease into inflation? Pretend the shock is temporary while markets reprice in front of you anyway? This is why metals matter here. In a clean world, policy tries to smooth cycles. In a disorderly world, people stop waiting for policy to save them. They reach for what does not need permission to hold value. That is, the mental switch gold and silver thrive on. Not optimism, not convenience, distrust. And distrust is spreading faster than most headlines are capturing. Look at the sequence again: regional strikes, direct retaliation, leadership decapitation, public threats, energy route risk, bank liquidity warning, weekend gold spike. That is not one catalyst, that is a chain. And chains are harder to stop than isolated incidents because each link reinforces the next one. War fuels fear, fear fuels buying. Buying stresses access, access stress validates the fear. Then the cycle feeds itself. This is why I keep saying the market open matters so much. Once the major exchanges come back online, everyone has to make the same decision under the same glare at nearly the same time. Ignore the weekend signal and sell into it? Good luck finding the courage for that. Step aside and let price jump until equilibrium appears? That means a gap that shocks everyone watching. Chase immediately because you know the physical market already moved? That means even more upside pressure in the first wave. None of those paths look calm. And calm is the one thing this market no longer has. I also want to address the people waiting for a soothing headline to erase all of this. A rumor of diplomacy, a leaked back channel, a statement about restraint. Could that create volatility? Of course. In a crisis like this, you can absolutely get brutal intraday reversals. Gold down hard for an hour, silver slammed on a ceasefire whisper, social media declaring the top. Then another strike lands, another warning comes out, another asset reprices, and the whole market turns right back around. That is what unstable systems do. They do not move in straight lines. They move in violent convulsions. So do not confuse volatility with resolution. That mistake ruins people. A sharp drop in the middle of a structural crisis is not automatically the end of the move. Sometimes, it is the mechanism by which the market clears weak hands before moving again. Especially when the underlying drivers have not actually gone away. Has the war risk disappeared? Has the physical strain disappeared? Has the bank warning been withdrawn because inventories are suddenly abundant? Has the oil corridor become irrelevant? No. Then the core thesis is still alive. And if the core thesis is still alive, price shocks become part of the story, not a rebuttal to it. Now let us talk about timing. I think the next major trading session matters because it will reveal which market has been lying, the stale paper close or the live fear price. One of them is wrong. If the reopen comes in anywhere near the weekend spike, that is an admission that the old pricing framework broke. If it overshoots even further, then you are looking at a classic panic catch-up move. And if it opens lower, but physical stress headlines keep coming, then all you have done is create a new invitation for buyers who missed the first move. That is why this setup is so dangerous for anyone still treating it like a normal swing trade. Normal swing trades do not involve leadership assassinations, regional missile exchanges, stress warnings from banks, and a safety asset repricing while benchmark venues are closed. This is not normal, and the market knows it. That is why the smartest thing you can do right now is stop thinking in yesterday's emotional framework. Yesterday's framework says, gold already ran too much. Today's framework asks, what is the price of trust when the system itself starts flashing strain? Yesterday's framework says, silver is too volatile. Today's framework asks, what happens when a tiny market gets hit by fear demand, industrial demand, and supply rigidity at the same time? Those questions produce different decisions. And there is one more layer the market has barely begun to process. Once words like nuclear, carrier strike, regional entry, and regime collapse start circulating in the same 48-hour window, you are no longer trading a headline cycle. You are trading tail risk. The kind of tail risk that institutions are trained to hedge immediately because the downside of being late is catastrophic. If even one of those possibilities moves from discussion to event, the repricing in metals does not happen in a measured staircase. It happens in air pockets and vertical candles. That is why this moment feels so different from every ordinary geopolitical scare. Normally there is a visible boundary, a statement, a mediation channel, a face-saving pause. Here, the boundary keeps dissolving. Each development makes the next one easier to imagine. First retaliation, then expansion, then leadership loss, then wider regional pressure, then questions about shipping, oil, bases, alliances, and escalation thresholds. By the time the public fully accepts that the map has changed, the price usually already has. And that is the cliff most people are standing near without realizing it. They think they are watching news. In reality, they are watching the monetary system reprice war, supply stress, and trust failure all at once. And before I close, I want to speak directly to two groups. First, The people who already understood why metals mattered. You were not crazy. You were early to a risk most people did not want to model honestly. Debt fragility, geopolitical fracture, supply stress, policy limits. That is what metals were for. Not to impress anybody. Not for a perfect chart. For this. For the moment when the world reminds everyone that confidence is not the same thing as stability. Second, the people still watching from the sidelines. I understand the hesitation. Every new high feels like the wrong place to begin. Every surge looks extended until the next surge makes it look cheap. That is the psychology of repricing markets. They do not ring a bell and offer a comfortable entry once everyone agrees. They force the issue. Then they dare you to react. So here is the real question I want you to answer in the comments. When the major exchanges reopen, does gold simply catch up to the weekend panic price? Or does it overshoot because the physical market has already moved ahead of the paper market? And what do you think silver does if the rush into safety becomes a full stampede? Because one thing is clear now. This is no longer about neat chart patterns or tidy narratives. This is about a world repricing risk at frightening speed. Gold at $6,000 in weekend trading. A bank warning that gold access may tighten. A regional conflict with no obvious off-ramp. Silver sitting in a much smaller market with even less room for error. That is not a routine weekend. That is a warning shot. And if this escalation continues, the next move will not ask anyone for permission. Hit subscribe, stay close to this story, and share this with someone who still thinks metals are old news. They are not old news anymore. They are the price of mistrust, the price of stress, and the price of a world that just got a lot more dangerous overnight.